So, good morning, good afternoon, good evening, wherever it is they're watching this video from. I'm going to welcome you to the very first video of the 5 days God's creation series we had. But then, this is going to be the day 2 video. The day 1 video, I was mentioning who should be concerned about investing in the stock market or wanting to trade the stock market. And one of the major highlights I want to do there is, or I want to bring to this particular video from the last class, was just that you cannot invest your way out of scarcity. Right? So before you go into investment, you need to gain stability first. So in the process on the ladder of wealth creation, if you're in a place of scarcity, you're in a place where you don't necessarily have much enough to sustain your basic needs, then you have absolutely no need considering investing in the stock market. Because once you make an attempt to do that, every single move you're going to get, you will not be as patient as you ought to be, in order for you to even allow the market do its things, or you will not even be as careful, as observant as you need to be, or as studious as you need to be, in order for you to be able to pick the right asset, because you might find yourself jumping from one opportunity to another opportunity to make big gain. So if you're in a place of scarcity where the ones or the little funds you have on you cannot handle, that you don't have funds that you can set aside for a minimum of at least a year, 6 months to a year, then I would not advise going into the stock market. Trading the stock market has potential risk, and no doubt you don't make a loss until you've sold that stock. So even if it goes down, the only thing is that the worth of your stocks reduced. And if you hold it long over time, and as long as your analysis and then every single thing is in alignment, you definitely will see the gain, but it could take some time before you start again. Right. So having said that, I want us to jump into what we have here. And this video, I'm going to be talking about introduction to investing and trading the stock market. Right. That was supposed to be investing and trading the stock market. So we're going to be looking at what is investing. And these are the items we're going to be looking at in this particular video. There will most likely be either I'll break this video to 2 different parts, part 1 and part 2, or I'll take every single thing in this slide in one video. Let's see how far we go with that. So we're going to be looking at differentiating between investing and trading, then active versus passive investing, retail trade investors and institutional investors, how the stock market works, the role of stock exchange, and the key terms and concepts you need to understand about the stock market. So let's proceed with what we have. Differentiating between investing and the stocks and trading. This is where it will now be easier for many of you to know exactly what to expect in the trading market, because in my own case, I would usually advise people to actively trade the high risk market, which includes the crypto market, the commodities market, the forex market, and invest in the stock market. But it could differ for many of you. So either ways, at the end of this video, you will be able to understand whether you should be, or you should take the approach of an investor, or you should take the approach of a trader in the stock market. So let's dive right into it, all right? So investing and trading are 2 different methods of attempting to profit in the financial market. Already are 2 different methods. You can either be a trader, you can be an investor, you can also be both, depending on your availability and pending your active role in the market. Somebody like Warren Buffett is more of an investor than a trader. All right, somebody like Lance Bryson is more of a trader than an investor. So any part you choose at all, both parts, it's a method of making profits from the financial market. Now, the financial market is large. Under the bracket of the financial market, you have the stocks market, which is also known as the equity market. You have the forex, you have the cryptos, you have the futures, you have the bonds, you have all those different assets. The commodities market also in it. So the stock market is what we're going to be focusing on during the course of this particular series. Right. So both investors and traders seek to make profits through market participation. All right. So both of them definitely will participate in the market. So investors generally really seek larger returns over an extended period of time through buying and holding. So if you're an investor, your goal is not to play much of an active role per se. All right. Your goal is to be able to get a very good stock and hold over a long extended period of time. For an extended period of time, it is not just let me buy and cash out in 1 month, or let me buy and cash out in 6 months. Sometimes you see these guys holding as long as, or investors holding as long as, sometimes 2 years, a year, 2 years, 3 years, 5 years, up to 10 years, and they are holding a particular asset. So that is one of the major approaches to profit from the market. So you want to you want to know whether investment seeks that is if taking the investment to is going to be much better than for you than trading. So if you are a person who don't want to actively trade, and then one of the things about investors is that the only way investors make money or lose money is when they sell off their stocks. There is only one position an investor can take in the stock market, and that is the buy position. An investor don't usually take sell positions. All right. So buy positions, I mean, is that you look for a good stock, so you buy that particular stock. So the goal is that when you buy the stock, all right, so when you get a particular stock, let's say it is, let me use Nigerian stock in this, our examples now, right? So let's say it is MTN that you want to buy. All right, so you buy that particular stock and you intend to hold it over a particular long period of time. That is just what an investor does, all right? So you're buying a particular stock, intending to hold. Now, no doubt, stocks can, some years go up, come down, go up, come down. So let's say you bought something around here. So for every single time price past that your particular price point, you're going to be losses, profit, and so on and so forth. But in the long run, we want to see the stocks go up. The only position an investor usually takes is a buy position to hold for a very long period of time. You cannot see all these sales right down, all this period where the markets come down. You don't make profit from that. You lose money from that, or you lose some part of your profit. Now, the only time you're going to eventually close or end up as a losing position in that your stock is only when you close out the market. So let's say you bought this particular stock at 10 naira, and then the thing rose to 15 naira. That means you're making extra 5 naira in profit. And let's say it came down to 2, you're losing 3 naira, just so on and so forth. So the only time you're going to make profit or loss is when you close this position. If you close it at 20 naira, that means you had a 100% return on the investment. If you closed it at 2 naira, that means you lost 3 naira in it. So until you close, the only thing that will happen is the worth of your stock will either increase or reduce. So if that is the approach, you buy a particular stock and you hold it long or over a very long period of time. All right. So having said that, who are traders? Traders, by contrast, they take advantage of both the rise and the falling of the market. So traders can make money when the market rise, and they can make money when the market sells. All right. So if I let the market go up today, come down tomorrow, go up today, come down tomorrow, traders can make money from either of those positions. But the thing is that for you to be a trader, you have to be very, very active. All right. And the goal is to make a position over a short period of time, taking smaller and more frequent profits. And investing usually takes a long-term approach to the market and often applies to such purposes as retirement accounts, people who want to trade it for a long-term purpose, all right? Whereas trading involves short-term strategies to maximize returns, either on a daily basis, on a monthly basis, or quarterly. So you see traders, they take a particular, there is a firm, I know, both a firm and an individual who trade Nigerian stocks, not invest, they actively trade Nigerian stocks. So you see them, they will give you an analysis of something like GTB, if it's GTB they want to invest in. So based on the analysis, they're trying to tell you, okay, GTB is sold at 15 naira. They are looking at GTB in the next 1 month to get to at least 18 naira. All right. And they are willing to hold, and they are saying, okay, fine, if it comes down to 13 naira, they're going to close out on that particular trader. We don't want to see based on the positions, based on every single thing, both the technicals, the fundamentals. We don't want to see GTB coming below 13 naira. We want to see them in the next 1 month get to 18 naira. So when they get there, they're making a particular percentage of profit. I think that is extra 3 naira, right? So that should be about 2%, 20% profit on that, guys. So 20% of the 100,000 naira is already 20,000 naira. So it's easy 20,000 naira for the trader. 20% on that particular profit is on a million naira is about 200,000 naira, and so on and so forth. So they just want to take short-term positions. They can also choose to sell if they want to sell. All right. So if they say, okay, this stock is already sold at 15 naira, but I see the stock selling all the way to 10 naira, they can choose to take a sell position and also profits from that. So, but in order for you to be a trader, you have to take a very, very, very much active position in the stock market. You need to take a very much active position in the stock market. So let's now go into that. The goal of investing is to gradually build wealth over an extended period of time. And this is done by buying and holding a portfolio of one or more asset class. This can include their stocks or a basket of stocks. For an example, you have the US 30, you have the NASDAQ 100, and many other basket of stocks. US 30 is made up of the top 10 or top 30 performing companies in the United States. So it comes, all those companies, instead of you buying them one after the other, let's say Tesla, Microsoft, Google, instead of you investing one after the other, there is a basket for them. So they put all those stocks. It's more like putting all those stocks into one basket and you're buying the entire basket. So the basket measures their average performance, and that is how it moves. So you profit over, usually basket of stocks are usually the safest stocks to buy. Right? They're usually the safest because over time, it's not as if they don't go down. Yes, they go down too, but then you just realize that over an extended period of time, it is trending all the way to the upside. So let me attempt to get to my screen right here because the goal is to bring out some of all these things to show you. The goal is to show you some of all these assets. So as we study, just a moment, sorry. I use this also for technicals, all right? So that is why it's going to just be like this. So this is US30 now, as you can see, is the asset symbol here is US30. And the US30, if you should, is a basket, let's see this, US30 or Dow Jones. So I don't know if it's going to explain it as much as here, right? So let's see the US30, what it's all about. So what does it stand for? Let's see. Just a moment. All right. So it stands for the Dow Jones, right? The Dow Jones Industrial Average, or simply Dow. It is the second oldest index in the US, and it tracks. So you see it here now. This index, so I'm going to highlight. I'm just dragging. So you see, this index tracks the stock performance of the 30 largest US company listed on the New York Stock Exchange. Pay attention to this New York Stock Exchange because we're going to also review it, and the Nasdaq Exchange. We're also going to talk about the importance of all these exchanges, right? So later, so if you look at this US30 now, this is the US30 index, and over time, you can see how the US30 has just been trading in just one direction, right? Over time. I'm just using this chart representation to show you guys exactly what we can expect or exactly how these things function. So you see, this was sometime in 2017, this was sometime in 2020. So in the year 2020, during the corona, because of the whole corona thing, what happened to the US stocks market or the US30 market? It dropped. So if you bought somewhere around here at $28,000 for a stock in the US30, it dropped as long as 28 to 18,000. But over time, it started rising up again. So you realize that overall, the index is one of the safest because in the long term, you profit. So many of the investors that want to play safe usually go for basket of stocks. Now, under the US30, you have the top 30 largest companies. So Tesla is there, Microsoft is there, Google is there, Berkshire Hathaway is there. All those big 30, top 30 largest company in the US, they all come under the basket of the US30. You also have the Nasdaq 100. So instead of investing in just an individual stock, like coming here now and then say you want to invest in Tesla, or you just want to only invest in Tesla, and you can see how Tesla has been going up, down, up, down. So if you're an investor, you bought Tesla somewhere around 2020, yes, you've been making some good money, but then, you know, around 2022 into 2023, it came back all the way down, and then it started going back up again. You realize that, okay, if your heart cannot carry it, it's going to be a whole lot of roller coaster. But then as an investor, your goal is just to buy and then hold. Now, just so you know, there are some investors that many years ago, as far back as 2007 rather, where is it? Okay, 2007 is somewhere around here. No, not 2007, sorry, 2015 is what I'm looking for. So sometime around 2015, they invested in Tesla. Now, Tesla in 2015 was what, if you look at this here, this was somewhere around 2015. If you look at what we have here, it's, sorry, let me forgive the way I reduced the notations there, right? So let me increase it. So you can see sometime in 2015, this was sometime in 2015. If you look below, if you look down here, so the down part, you usually have the price put, or the date quoted, and then to the right side, you usually have the price quoted. So sometime in 2015, or even January 2016, all right? January 2016, sometime around there, Tesla was sold for 14 naira per share. 10 years later, 14 naira per share. Currently, Tesla is sold at $411, sorry, not naira, dollar per share. So you realize that investors, if you had put $1 million here, you put in $1 million, as at the time Tesla, as in maybe as of 2016, you invested $1 million in Tesla, all right? 10 years later, your $1 million has generated over 1,000% return on investment. What is even 1,000% return on investment? Because you divide 411 divided by 14, all right? Then, sorry, let me load this up. So you have 411 divided by 14. That is almost 290, sorry, 2,900% return of investment. That is times 100. Now, when you now do 411 divided by 14 times 100, that is for percentage, you had a 2,900% return of investment on these guys. So that means your $1 million invested in 2016. This is 2026 February. 10 years later, currently Tesla is sold at $411 per share. That is a whooping 2,900% return of investment, which is in turn going to mean that your $1 million is already worth $29 million without having to do anything. $29 million without having to do anything. So this is the role of investors. Whereas traders, you have traders that buy, they sell, they buy, they sell, they buy, they sell, and then the rest of that. Okay. So having said that, let's proceed and more examples. So if you don't want to now be investing in an individual stocks, you can now consider going with a basket of stocks, which you now have to be, for example, what we're looking at, the US 30. All right, so you have the US 30. So the US 30, which Tesla is obviously part of. So you can now begin to consider wanting to invest in the US 30, and then you can see how they've just been trending all the way to the upside. Not too much down movement. You don't see all those heavy down push on the US 30. It's usually trending all the way to the upside. You usually always look at it over the years. So baskets of currencies are usually the safest to invest in. If you want to invest, baskets of currencies, baskets of stocks are usually the safest to invest in. All right, so proceeding with what we have, let's consider this. So we're saying that this includes stocks, basket of stocks, mutual funds, bonds, and ETFs, and other investments in those instruments. So investments are often held over a period of years, even decades. As you can see now, that Tesla one that we look at was just over a decade. Now, over that particular decade, you can see how it gave you about 2,900% return of investment in a decade. Now, you can imagine doing that with various other assets and diversifying your portfolio. That is how these guys make money. So now taking advantage of perks like interest, and also aside the fact that you make money from the increase, you can also, that is the increase in stocks price, you can also make money from interest or dividends and other stock splits along the ways. So whereas trading involves no frequent transactions, so such as buying and selling the stocks, commodity, currency, or whatever instrument. And the goal is to generate returns that outperform buying and holding investing. An investor, it can take an investor 10 years to make 2,900% return of investment, whereas a trader can easily make that in sometimes 2 years, 3 years max, or even 4 years if the trader knows what he's doing. All right, because you are trying to catch every move. But then investing is more peaceful than trading, not exactly completely more peaceful, but then you realize that you put in your money, you go to rest, allow the money work for you over a long period of time. Whereas when it comes to trading, you have to be active. You cannot even become a passive trader. You have to become an active trader. So you are buying and selling at every point. You are buying and selling at every point, depending on the strategies or the techniques you employ, which we're going to be looking by our next class. All right, in the next video, we're going to be looking at that on how I go about selecting stocks and carrying out analysis. So these guys, they intend to make 10 to 15% annually. Sometimes it's not even annually, right? Okay, right. Sorry, investors tend to make 10 to 15% annually and they are happy. Traders, they want to make it on a monthly basis. If they can get 10% on a monthly basis, they're happy. 100% return of investment, 100% return of investment on a yearly basis is more than short. Sometimes some traders, they feel they didn't even do much with a 100% return of investment. Whereas an investor is so happy that they did a 100% return of investment in a year. So traders, their own is they want to make that return as fast as possible. So it is generated at buying and selling, active buying and active selling. So if you are not very much knowledgeable or you are not venturing into active financial market participation, I wouldn't advise that you go into trading. I would say that you just focus as an investor. But if you want to learn it, yes, you can. It's something that can be done. I myself am a trader. and I both trade and invest. So let's proceed with what we have. So what is active and passive investing or trading rather? Active investors. So investors generally tend to make one or two types of investment approach. And these styles are noted below. So this is what it means. All right, so they are noted below such that investors who take an active investing approach usually tend to monitor the market on a regular basis and make changes accordingly. So you see them, all right, if they are trading a particular stock, all they want to do is, if I'm trading Tesla, I want to watch, okay, based on what is happening, I feel this month Tesla is going to drop. They will close out their position maybe in a little profit, wait again for the market to come down, then they buy again. So they are always entering, exiting, entering again, exiting, entering again. When they pull up, the exit. So you see these people monitoring the market performance, sometimes on a monthly basis, sometimes on a quarterly basis, and the rest of all that. So that is what active investors do. So they generally seek out particular investments and try to make or outperform the returns on a specific benchmark index. Whereas passive investors, they follow a buy and hold. So this one, they don't even have time to be closely monitoring the market. Once they go to maybe a professional or get investment advice on exactly what to do, then the next thing they want to do is just to buy and hold. So those ones, they don't want, I know friends, I know people who are very, very much passive when it comes to investors. Like some of my friends, I'll be like, how far that stock we discussed last day? They say, yes, it's still there. They've not even checked it. They've not even done anything about it. Those are passive investors. In my own case, I'm both passive, I'm both active. I am both an investor and I'm also both a trader. So these are the things that we look out for when considering who or when you want to consider which style invests you. You want to become an investor, a trader, an active investor, a passive investor. All right, so moving forward, who are retail and institutional investors? Let us look at the difference between retail and institutional investors. So an institutional investor is a company or organization that trades security in large quantities to qualify for preferential treatment from brokerage and lower fees. So example of an institutional investor now, you have, let me bring it home. You have, is it Cowrywise they call them now? Yes, Cowrywise is more like it's both a broker and also an institutional investor. You have GTB Investment Company. You have United Capital, that is for UBA, their investment firm, United Capital. You have Coronation. All these guys are institutional investors. So they are more like large companies, Berkshire Hathaway, where Warren Buffett is their CEO, right? So Berkshire Hathaway is an institutional investors. So they are companies, all these large companies that carry out all these investments stuff, all right? So that is who they are. That is what the company do as a living, all right? You have Cowrywise, you have many of all these institutional investors. Whereas the retail investors in the opposite way are just like me and you. We are individuals. We're not like an institution. So in order for us to be able to carry out our transaction, we need to carry out through a broker. So I was sharing with you guys that, okay, fine, you can either use Trove, you can use Meristem, you can use Bamboo. All those things are platforms through which individual or retail investors like I and you can, buy or invest into the stocks market. So when it comes to institutional and retail investors, these are the two different people, or these are the two different investors that participate in the market, categories of investors that participate in the financial market. So you're either working with an institution or trading as an institution, or you're trading as a retail. In our own case, we are retail. All right. So these are just the difference between a retail and an institutional investor. Let's now talk about how the stocks markets work. So stocks market are organized platforms where buyers and sellers come together to trade shares of publicly listed company. All right, so this is what I'm going to do. Permit me to end this video now, so that I don't want to make this video as long as, so I'm going to end this particular video, and in our next video, we're going to begin to talk about how the stocks market works. So I want to break it so that I don't want this video to be as long, more than 30 minutes, and I'm thinking it's already getting to that, or even not more than that already. So we're going to look at the next video on how the stocks market work, and we'll now proceed from there to looking at how to go about conducting analysis in the stocks market. So we'll see you guys again on the next one. Shalom, shalom. Take care. Bye, guys.